All right, now, in order for this to work, and your readings don't point this out, that's why I always think it's important to understand things in context and not just read. And I don't know why they don't provide this in the prep providers materials or in the CFA books, is the following. In order to sort of show this relationship between the forward market and the spot market, and to assume that a forward rate is a future expected spot rate, number one, we have to assume that the bond markets are efficient. That's number one, that the bond markets are efficient. And then we also have to be supporters of a particular theory on the term structure of interest rates, which you will see in Level 2. It used to be in the Level 1 program, but it's in the Level 2 only now. And that is called the pure meaning unbiased expectations theory. This is very important because then you can understand this material. So we have to assume that the bond markets are efficient and that we are supporters of the pure expectations theory of interest rates. And the pure unbiased theory of the term structure of interest rates basically says if we see an upward sloping yield curve, if we see a upward sloping yield curve, meaning that as maturity increases, so do the yields, how does a supporter of the pure unbiased expectations theory explain this upward sloping yield curve? They would say that if they look at the upward sloping yield curve, that they expect future short-term rates to rise. Future short-term rates to rise. A downward sloping yield curve would be an expectation that future short-term rates are expected to decrease. And if a yield curve is flat, we're expecting future short-term rates to remain the same. So in other words, the pure expectations theory or the unbiased expectations theory can be used to explain any shape of the yield curve. However, it's called the unbiased or pure expectations theory because it's explaining that the shape of the yield curve is based on one factor alone. Future expected short-term interest rates, which is all based on what? Inflation. So nothing else is explaining the shape of the yield curve except inflation. That is the point. And then later on in Level 2, you'll get into other theories like the liquidity preference or the biased expectations theory. You'll also get into the preferred habitat and the market segmentation. Don't worry about that now. I just want you to understand the relationship between forward rates and spot rates, and that's based on the pure expectations theory of interest rates, which says that a forward rate is an unbiased expectation, is an unbiased predictor of future expected spot rates. So if that is the case, that we believe in the pure expectations theory of interest rates, and we believe that the bond markets are efficient, guess what? If I have a 2-year investment horizon, using the table that you still have in front of you with these spot rates, if I have a 2-year investment horizon, I want to invest for 2 years, I have a choice. I could invest in a 2-year bond, and how much would I earn? I would earn 7%. Fantastic. I would earn 7%. I have another alternative. If I believe in the pure expectations theory of interest rates, which basically says that a forward rate is nothing more than a future expected spot rate, I could do what? Instead of investing in a 2-year bond today, earning 7% per year for 2 years, I could invest in a 1-year bond today, earning 6%, and then what would I do? At the end of the 1 year, I would collect my proceeds, and then I could roll it over into another 1-year bond 1 year from now. And the returns on those two alternative investment opportunities should give me the same overall return. So that is the idea here. So now I'm going to take the example a little bit further using that same table that you have in front of you. And I'm going to say, you know what, instead of a 2-year investment horizon, let's say I have a 5-year investment horizon. Okay? If one alternative, as you can see, is I could earn 10%. I could buy a 10-year bond. I could buy a 5-year bond today and earn 10% per year for 5 years. That would be 1.10 to the fifth, as you see in the calculation. What I could also do is, if I believe in the pure expectations theory of interest rates and I believe in that the bond markets are efficient, I could invest in a 4-year bond today, earning 9% per year. Okay. And therefore, that would be 1.09 to the fourth. And then I would have to geometrically link that to the 1-year forward rate 4 years from now. In other words, I know that the 5-year rate today is 10%, that the 4-year rate today is 9%, but I don't know what a 1-year bond will be offering me 4 years from now. If I did, I would have a crystal ball. So what I want to know is, what is that break-even rate? And that's what the forward rate is, which I mentioned before. It's a break-even rate. What is that break-even rate that I would have to earn in the last year between years 4 and 5 so that the returns on those two investment alternatives to the right of the equal sign and to the left of the equal sign are the same. So I would solve for that 1 year forward rate 4 years from now. Now, you'll notice that in my formula, I wrote it as 1F4, right? And that's because I like to keep it up here, and I want to remember it, and I don't want to forget it, and that's how I was raised on it when I did the CFA Level I program is I read from left to right. 1 year forward rate 4 years from now. Means the 1 year forward rate 4 years from now means I initially invest for 4 years, and then I'm going to invest for an additional year. So that's the one, we read it from left to right. 1 year forward rate, 4 years from now. Your books or your notation does it now in reverse, and that's what you see at the top of the screen. 4Y, 1Y, which means the 1 year forward rate 4 years from now. Whichever way floats your boat and you can remember it, it's fine. I like it the way that I have it in the formula, 1F4. Either way, and then for the purpose of the exam, you just reverse it, 4 and 1. So 4Y, 1Y. Again, it's whatever helps you to make it, remember it easier. Because you don't want to confuse the 1 year forward rate 4 years from now with the 4 year forward rate 1 year from now. You don't want to confuse those two. If you do the math, which I hope you can do, you should come up with an answer of 14%. So the 1 year forward rate 4 years from now is 14%. How do I interpret that? I would interpret that simply as, if I am an investor and I have a 5-year investment horizon, I should be indifferent between buying a 5-year bond today, paying me 10% per year over that 5-year period. And on the other hand, the return should be the same. And on the other hand, investing or buying a 4-year bond today, providing me with 9% per year over each year for 4 years, and then rolling the proceeds over that I receive at the end of the 4th year into a 1-year bond offering 14%. The overall rate of return over that 5-year period should be the same. So that 14%, that 1 year forward rate 4 years from now, that is a break-even rate.